Thanks a lot for the organizers for inviting me to this very interesting conference. This is a joint paper with Gustavo Leyva, who's also here as panelist, so he can help answer some of the questions. And it's going to be very complementary to the previous presentation. So I think this discussion that we are having at the end about what kind of policies can help a recovery, taming at the same time the rise of informality, is something that is also going to be at the core of this presentation. The usual disclaimers apply, and we also thank the sponsorship of the Inter-American Development Bank for this project. So I'm going to talk about basically two things. I'm going to talk most of the time about data. So we're going to have two sections that are going to be very much about data intensive. In the first of them, we're going to talk about Mexico, just because we have more disaggregated and finer data for Mexico. And we're going to talk about what is the impact of the COVID recession in labor markets. Then we are going to try to extend some of these results to a wider set of Latin American countries. And then in the second part, I'm going to present a model that is going to be based on my previous work with Gustavo. And we're going to use this model in order to basically to do two things. One is, So one is to try to recover what kind of shocks can rationalize the type of pandemic recession that we are observing. And the second one is to use this baseline scenario as a laboratory in order to try to different policies that can help to recover the economy once the medical condition of the pandemic passes. So let me start with the first one. I'm going to talk about the recession in Mexico. The first thing that I would like to say is that this recession looks very different from the past. So if we took the Great Recession of 2008, 2009 as a benchmark, but this is also true for previous recessions in Mexico, those recessions were characterized by a fall in employment. That's not surprising. This fall in employment was accounted for a combination of a decline in labor force participation, that is an increase in the inactivity margin, together with an increase in unemployment. And one thing that was very common to all the previous recessions is that informality tend to increase in recessions. We had a sizable rise in the informality rate that was part of this counter-cyclicality of the informality rate that we observe more generally in Mexico. One thing that we show in a previous paper with Gustavo is that this increase in the informality rate doesn't imply necessarily that there is a reallocation of formal jobs towards informal jobs. In fact, informal employment also decreased, but the decrease was much dampened compared to the big drop in formal employment. The margin that reconciled the two things was, as I was saying, a big decline in labor participation. However, if we look now at the 2020 pandemic recession, at least for now, I'm going to show you only data for the second quarter of 2020, then this recession looks different in some important dimensions. One of them has to do just with magnitudes. The drop in employment that we observe is much larger than the one in previous recessions. And right now, and in the current episode, is almost entirely accounted for a decline in participation. There is a very minor role for the unemployment rate in the dynamics of the labor market. But more importantly, and comparing to the previous recessions, what we observe now is an unprecedented decline in the informality rate, which is driven by a huge destruction of informal jobs. This is something that was also mentioned yesterday in the panel for a wider set of countries. The informality has played a very different role in this recession than in the past. And we have now a drop in employment that is that is widely led by a decline in informal jobs, by the destruction of informal jobs. So let me start my discussion of the data by showing you what I'm going to mean by the things that I'm going to show you in the following graphs. So we're going to divide the working age population using household surveys for Mexico in 4 categories: employment, that can be further divided in formal and informal employment, unemployment, and out of the labor force, on inactive workers. And we calculate the usual labor market indicators like the employment rate, the inactivity rate, the informality rate. And we're also going to show you some results about gross flows or transition across these 4 labor market categories. So let me start by the stocks, or by the main labor market indicators for Mexico. Here what we do is to compare the pandemic recession, which is the yellow bar that we have at the end of each one of these graphs, with the first quarters of the 2008-2009 recession as an example of a typical recession in Mexico. Amazing compared to what we had in even the Great Recession of 2008-2009. And this is mirrored by an increase in the inactivity rate. The role of the unemployment rate is very minor in that adjustment. Now, if we look at the formal versus informal division, what we observe now is a big decline in the informality rate in 2020, compared to the usual increase in the informality rate. And this is mostly led by a big destruction of informal jobs. Formal employment has declined as well, and in a magnitude comparable to previous recession, but what we have now is a huge destruction, an unprecedented destruction of informal jobs. We also analyze gross flows and the job creation, job destruction margin. And one thing that is also very, very, very striking is that while in the past the decline used to be a combination of lack of job creation with an increase in job destruction, here is very much biased towards a big destruction of jobs in the first quarter of the pandemic. Which jobs were destroyed? What this is showing is that comparing formal with informal, job destruction was higher in the informal sector, and job destruction towards inactivity instead of towards unemployment were the main flows responsible for the decline in employment in this episode. Let me finish the description of the data for Mexico, talking about 2 non-conventional margins that used to play a very, very minor role in the previous episodes. The column at the center is the decline in employment that I have shown you in the previous graph. It's 19%, that's about 10 percentage points, the decline in the employment rate in the COVID recession compared to a 2.2 decline in the Great Recession of 2008-2009. So what we add to this analysis is 2 categories: temporary layoffs, which are the type of rest and employment that Paco was talking yesterday. I think that Professor Hall is going to talk more about that in the next presentation. Here the idea is people that are non-employed but that are expected, that keep some type of tie with their original job, and they are expected to return in some time horizon. Just to notice, at least in Mexican data and in most Latin American countries, these are not considered part of unemployment. They are spread over mostly inactivity, and a few of them maybe as unemployed. So one question is, how big are those, and how big are those compared also to past recession, and how do they contribute to the fall of employment? One could say that these temporary layoffs are not really inactive people. They are just taking a rest, and they shouldn't be counted, or we could conceive a measure of employment that includes this type of workers. If this would be our third column, these are the people that we consider as employment in the data, plus this temporary layoff. And if we look at the differences in these numbers, is very big. That means that if we consider temporary layoff as part of the employment rate would have fallen by much less than what we observe in the data. And the other thing that I want you to show you is that this margin make almost no different in the past. So this is something very peculiar to this particular COVID recession. However, we have also another margin that I think is important and has been maybe overlooked. This is what we call absent employees, or what the data call absent employees. Absent employees are considered as part of the employment rate, the employment stock in Mexico and in most countries. But these are people that are not, for several reasons, they are not working in the particular time frame of the survey. That is, they are considered employed, but they didn't work in this period. They could be on vacation, there could be several reasons why they are not working. Again, in the past, that didn't make much of a difference. It was a tiny fraction. Now it makes a big difference. So we have a big part of this employment that is, to put it in the frame of the model, they are not part of the labor input. They are not engaged in production at this point in time. So if we want to take those people away from employment or subtract these people from employment, then the drop in this employment will be even higher, will be much higher than the 20%, almost 30%. So this 19% is I would say, like a good compromise between these two margins, that non-conventional margins that we have in the data. Now let me talk about other countries in Latin America. So we do an analysis based on public available surveys for Brazil, Chile, Colombia, Mexico, I already talked about, and Peru. One thing that I want to say about this is that each one of these surveys has its own definitions, for instance, about what it means to be informal and so on. We haven't made an effort in order to make those homogeneous across countries. So we're using the official definition of each of these categories that each country imposes in its survey. And in a nutshell, what we found is that some of the things that I was telling you for Mexico easily generalized to almost all of this country. In all these countries, we observed this big drop in employment linked to huge declines in participation rate. For some countries, like Colombia, the role of unemployment rate or the increase in employment rate is higher than for other countries. And we also observe across the board this unprecedented destruction of informal jobs, with informality rates increasing in this first quarter of the pandemic. And there is one big exception there, is Peru. Peru is with informality rates decreasing in all countries, with one big exception, which is Peru, in which the informality rate increased a little bit. Just to show you very quickly, this is the summary of these results for all countries. The first bar is the employment rate, drop across the board. Then the blue line, the dark blue line, is the informality rate, and it fell across the board with the exception of Peru. This is what I was saying, it's the only country in which the informality rate increased in the pandemic. And then there is a big increase in the inactivity rate, a drop in participation, and a milder increase in the unemployment rate, except for Colombia, where the importance of these two margins is reversed compared to the other countries. One last thing before going to the model about just the data. We report some also these indicators also by gender and age. The idea was that we all have this expectation that the type of pandemic and confinement policies that we had might disproportionately affect, for instance, female workers and young workers. And in fact, this is the case. So we find that there is a larger fall in participation for females relative to men and young workers compared to older workers. But one thing that I want to stress as well is that the aggregate results that we are showing here is not a composition effect. So we observe this decrease in participation also for male workers. We see the increase in the informality rate also for men, the decline in informality rate also for men compared to women. So even though the COVID recession disproportionately affected some group of people, it was something generalized across the economy and not a result of just a composition effect. I think I'm going to skip this graph that are showing exactly that for all the countries. You can find them in the paper. So now coming back to the second part of the presentation, I'm going to show you a model of a dynamic general equilibrium model, real business cycle model, if you want, of the economy, which is going to be based on my previous work with Gustavo. And this model is going to have some of the margins that have been discussed before in my presentation of the data. For instance, our model is going to have an endogenous participation in the labor market decision. So the participation, the inactivity rate is going to be endogenous. It's going to have formal and informal sectors. We're going to have in the formal sector matching frictions that slow down the flows of workers there, including firing costs that, as the previous discussion was saying, are important in order to understand the dynamics of employment. One thing that this model, all this labor market, rich labor market structure is going to be embedded into a small open economy model that is going to be subject to some shocks, and it's going to be embedded in the casted in the framework of a representative family. So that means that there is full insurance, even though some members of the family might be unemployed, some might be working formally, some might be working informally. At the end, everybody consumes the same and enjoys the same value of leisure. I don't know how much time I will have to go into the details of the model. You can find that in the paper itself. But the way in which we model the production side is very simple. We're going to have an aggregate technology to produce the final, the only good using capital and intermediate goods. And these intermediate goods are going to be produced in the formal sector and in the informal sector, which is going to model basically as a self-employment alternative. These two sectors are going to have different productivities, and this is one of the trade-offs that was being discussed before. The formal sector, this is the productivity of the formal sector is going to be higher than the productivity of the informal sector. And that means that once we do the aggregation of the model, we get a production function for the economy that is going to have an endogenous TFP component that is going to be affected by the share of workers in each one of these two sectors. In the formal sector, we're going to have the usual Mortensen-Pisarides machinery with a matching function that determines the job finding and vacancy filling probabilities, a law of motion for formal employment, which we have an exogenous separation rate every period, and then job creation, which is the endogenous margin in our model. And in the case, and in the formal sector, is also going to be the one that pays payroll taxes and separate costs in the event of separations. So I'm sorry if I'm very, I don't go too deep into the model, but this is just because of the limits of the time. The representative household, as I said, this is all casted in the framework of a representative household, is going to divide its time in these four categories that correspond to the four categories in the data that I just showed you: formal, informal employment, unemployment, and out of the labor force. Employed workers make some labor income, but enjoy or suffer a disutility of work. Unemployed workers face a utility surge cost. People inactive don't pay any of these costs, but they don't enjoy any income. The model is going to be calibrated using Mexico as an example of an emerging economy. Some of the parameters are going to be just outside the model. For instance, the separation rate is just computed from the data, from our same data source. Some more parameters are going to be calibrated in order to get, on average, for instance, the right informality rate, the right unemployment rate, average for Mexico, and some other parameters are going to be calibrated to business cycle targets, such that the model reproduces quite well some labor market, some business cycle moments for Mexico, in particular the counter-cyclicality of the informality rate, which is something that, as I said, used to be property of the Mexican labor market during recessions, during the business cycle in general. So what we are going to talk about now, the pandemic recession, what we're going to do is to add new shocks. So far, the model had two shocks, which were the technology shock and the foreign interest rate shock. Those were fine in order to describe the dynamics in previous episodes, but that's not enough in order to talk about the current episode. So that were two shocks. One shock to the labor supply, and this is embedded in the disutility of work parameter, and one sector-specific productivity shock, as opposed to the aggregate technology shock that we had before, which is going to be specific to the informal sector. And the idea is to represent, with these two shocks in a reduced form, the impact of the COVID-19 in the economy. Is very, very reduced, but from the previous discussion, and also from yesterday, from the previous paper, we can see why the informal sector might be disproportionately affected by the pandemic, and in particular by the confinement measures taken in order to attack the pandemic. So these shocks are going to be very low variance. They're just going to affect, they're not going to affect the calibration, but they're going to pop up in the pandemic. And the persistence of these two new shocks is going to reflect, to some extent, our expectations about how this is going to last. And we all know that we really don't know. So I'm going to show you how we put some discipline, and we are going to do a lot of sensitivity about it. So the accounting exercise, the idea is to recover what are the shocks, including these two new shocks, that account for the behavior of the output, employment, the labor market indicators in the pandemic recession. Very quickly, just to show you, these are the recovery shocks. This is very similar to the business cycle accounting of Charikhi-Homagratan idea, which is to get the shocks that exactly make the model to account for the drop in output, employment, the drop in informality rate that we observe in the data. Just look at the last bar, which is for the 2020 Q2, is the shocks that rationalize this. And we need a very high work disutility shock and informal productivity shock, as opposed to the general technology shock, in order to rationalize the big drop in employment and the decline in the informality rate. So we don't take no stand in the paper about where these two shocks are coming from. It's just a reduced form of representing the impact of COVID. It could be because informal activities are more contact intensive. You can choose your favorite story, but what this is saying is just you need to have something that affects disproportionately the informal sector in the economy. Let me skip this. It's just the composition of the contribution of each of the shocks to the variables that we try to explain. And this is the fit of other variables given the shocks that we have uncovered. And here, let me say that the model reproduces by construction the drop in net exports in the current account, in the sense that we choose the value of the persistence of these new shocks as to reproduce this exactly. Shocks to last, well, this is going to be reflected in their savings or borrowing behavior. And this, therefore, we use this aggregate measure of the borrowing of the country in order to discipline this parameter. Then we can simulate the recoveries, just letting these shocks come back to trend. This is the expected path for the endogenous variables. For some of the endogenous variables, notice that there is a band. This is not really a confidence interval or anything. It's just playing with the values of this expected of this persistence of the new shocks, meaning that in some scenarios we believe that we assume that the persistence is lower than in other scenarios in which the new shocks are more persistent. So one thing to complement the previous presentation is that we also in our model also predicts a faster recovery of the informal sector than even an overshoot of the informality rate compared to its value prior to the crisis. Then that takes us to the policy discussion. We are simulate the same recovery using different policy alternatives that can be easily mapped into our model. We are going to try 4 things: a payroll tax cut. This is part of the carrot in order to increase formality. A hiring subsidy to vacancy posting, which is also affecting it's also incentivizing formal job creation. Unemployment benefits and an informal income subsidy. The way we discipline these policies is assuming that all of them are going to last only for 2 years, and we scale the size of each of these policies so that all of them cost the same, which is about half a point of GDP per period. So the first 2 policies, the payroll tax cut and the hiring subsidy, they all affect the same margin, which is job creation in the formal sector. And the 2 of them promote a faster recovery of employment. This is the dashed line, the counterfactual, and a decline in the informality or a dampening of the increase in the informality rate. But notice that the hiring subsidy has much bigger effects than the payroll tax cut. And this is because the hiring subsidy, remember that we are bounded having the same fiscal cost of the 2. The payroll tax cut has to be paid to all existing formal firms. The hiring subsidy also only targets what we want, which is the creation of new formal jobs, and in such a way is a more cost-effective policies to achieve the same thing. Well, discussing the paper how difficult it is to implement a policy that targets so well exactly this margin in practice. Unemployment benefits and informal income subsidy, on the other hand, have the unemployment benefits only increases the unemployment rate because there is also the weak labor demand remains. The informal income subsidy increases employment or makes employment to recover faster, but that has the unintended cost of increasing the informality rate and therefore dragging labor productivity and GDP. Just to conclude, this is my last slide. So a few caveats that we are aware about the simplicity of our analysis. So there are 3 things that we believe that make our analysis. We have to take it with a grain of salt. One of them is that we don't have any epidemiological model behind, so we are not capturing any feedback that policies might have to the pandemic itself. We are taking the pandemic as a shock or is embedded into several shocks. We ignore distributional issues, and that might be, of course, of first order importance if we want to talk about policy. So there is no role here for income protection of poor households that might justify, for instance, this sort of informal income support that in our model, this is taken care by the perfect risk sharing that we are assuming. And also in our model, separations are exogenous. That is that there is no role for protecting existing jobs. Existing jobs are going to all be destroyed by an exogenous rate. So there is no feedback from policy into the separation rate. And that will require a model of heterogeneous firms if we want to talk about that. And I think that some of those models have been presented yesterday and maybe presented also today. Thank you very much. This concludes my presentation for now. I'm happy to answer any questions that you have.
Thank you, Carlos. It was good on time and a very interesting presentation. I can see a question that has been answered in the panel. So if it is another question, No
There is a
question?
yes, there is a question by Juan Guerra. I will unmute Juan. Juan, you can speak now.
Hi everyone, can you hear me? Hello? Can you hear me?
It's very.
It is very low, Juan.
How about that? Is that better? Okay. Thank you, Carlos, for a very interesting presentation. I was wondering how self-employment, which is your proxy for informality, works. Is there any capital in the informal sector? If not, is it akin to home production? So that was a first question. And the second one was related to your shocks, the shocks you used to replicate the recession generated by COVID. They're both supply shocks, right? So one is a labor supply shock and the other one is a productivity shock in the informal sector. But we think that the recession is a combination of both supply and demand shocks. So do you think you're missing something by just using supply shocks to generate the COVID recession? That's the second question. Thank you.
Okay, so thanks a lot for the two questions. With respect to the first one, just one clarification in the data part, which is the first half of the paper. When we talk about informal sector, informal workers, those include both self-employed and wage earners. We should maybe also decompose the two. We have done it, but it's not in the paper, and the behavior of the two subcategories of informal workers is very similar during the recession. In the model, as you rightly pointed, we are also only modeling the whole informal sector as being a self-employment sector. So there is no capital, as you said. It's just an option that you can use with your time, which is to operate this technology. And this is very much akin, as you mentioned, as home production. The only difference is that you produce something that is value in the market, but the structure is very similar to a model of home production. With respect to the second question, you're right. Notice though that the way in which, if you look at the labor market instead of the product market, we have one labor supply shock, which is the shock to the disutility of work, and we have several labor demand shocks, which are the shock that firms face, and then they might change the labor demand over a cycle. For instance, the technology shock is a labor demand shock in the context of our model. So this is the way in which we were trying to identify labor demand and labor supply shocks in the model. The model doesn't have really a scope for some sort of Keynesian demand effects, but this is something that could be added. In terms of how that will affect our accounting of the labor market, I'm not that sure, in the sense that it will be an extra shock to labor demand added to the other two that we have mentioned. But thanks a lot for your questions.
Thank you for the answers.
Yeah, very interesting paper. I'm trying to think about why the informality sector shock actually matters so much in your model. And this has to do, I guess, with the previous presentation, which is the informal sector is not only like an alternative sector, but it differs in substantial aspects, right? Like, for example, it's much more service-oriented, and probably the amount of contact associated with that sector is much more prevalent than in the formal sector. So it's that what has mattered in this pandemic situation is that the shock actually mattered to that kind of sector that happened to be associated with informality, right? And that's probably a way to think about how to interpret the informality shock in your model. How can I explore that in your model? That's something probably if you had like two sectors that had different degrees of contact, and contagion, and one of the sectors were more exposed than the other in that regard.
Yes, Roberto, this is exactly. Notice just one caveat to what you said. We have to go really fine in terms of what we call a sector for that to show up in the data. What I mean is that I haven't showed that, but if you look at what happened with the informality rate within sectors, you observe things that are kind of surprising. For instance, we have a big drop in the informality rate within manufacturing. That is, even if we forget about services, I think what you said is right, but you have to go more into maybe an idea of occupation rather than a sector. No, maybe inside the manufacturing sector, you have workers devoted to production, some devoted to services around the production structure, and those were the most affected. So you're totally right, but the drop in informality again is not just a composition effect across sectors, at least across the widerly defined sectors in the economy. You have to go into a much deeper analysis to start identifying sectors, subsectors of occupations for which you have a very different behavior of informality.
So just a small comment. I agree that it's more occupations than sectors, but there's some sectors that in general were particularly hit that do fit the high contact and informality, which is restaurants, accommodations, for us who have tourist sectors, and anything related to that. And that does fit this high contact informality.
Sure. I fully agree.
Yeah, but I agree with your point. I had a question, and perhaps it's a follow-up to the question that Roberto asked us, which is, what should we be trying to do in terms of policy options? I know now there's a lot of talk about jobs, and since the jobs that were lost were informal jobs, there's a concern about that. And your policies are trying to increase this type of jobs, but should we aim to increase any type of job? Should we try to increase value added? And does the jobs that go for that? Or are we really trying just to increase informal jobs? And that goes to the result that you're getting with payroll. It is a short run, and also you're trying to contain the fiscal implications. But one can think that we can try to solve the problem somewhere else and not necessarily with a payroll tax reduction.
Of course. I mean, I can only talk about policies that can be fit in our framework. And our framework is very, very simple. So in our ranking of policies, the one that we prefer, but this is just by the design of the model, is that policies that target job creation in the formal sector. Why? Because that makes employment to recover faster, and also because that changes the composition towards formal jobs, which are more productive and have some additional benefits that are not captured in the model. Now, what is a good policy in order to foster job creation in the formal sector? In our model is just a subsidy to vacancy creation, but this is very abstract. No? How do we envision such a policy in the real world but what the model is contributing to this discussion is to say you might have a policy that incentivizes formal employment, which is like a reduction of the payroll tax, but it's going to be very, very, very costly. If you could better target what you really want, which is creation of new jobs in the formal sector, that would be much more cost effective. But I agree that I don't have an answer to how can we implement in practice something so well targeted as we can by designing the model.